Hey guys, so today in this lesson, I want to identify the market structure for you and for you also to get the clarity on how the market is moving and what the direction would be and how to expect when the market will be going in a bullish trend or in a bearish trend. So the market is always doing some certain type of adjustments to get liquidity, um, and that liquidity is when it's swept, it tries to go in an opposite direction of the liquidity sweep. It either goes down or upwards. It depends. Sometimes the liquidity sweep is taken and it keeps moving downwards if the market is moving downwards. So there's some type of continuation into it. We never understand it because it's not us who are manipulating the market, it's the market makers. So what I want to explain to you today is that in the charts, looking from far away, I'm just going to take a screenshot of this just to show you how is this working, okay? So from the screenshot, we can identify these. So let's start from this point here, okay? This is our starting point at the bottom left. So what does the market do at the bottom left? The market is going in an upward direction. So it starts from here, goes down, goes up, goes down, goes up, goes down again, takes a huge amount of liquidity down there, continues back up, down, up, all the way here, down, up, down, up, down, up, down. So what you will notice is that the market, when it's doing this movement, it is creating a higher high over here and a higher low, okay? A higher high and a higher low. So when the market does a higher high and a higher low, what it means is that the market at this point here, it's not being disrupted. So the market does not go and play backwards to that line and disrupts it and goes beyond it. So in this trend, it is bullish when it's making a higher high and a higher low. And that higher low is not passing the previous point, the previous low. All right. So as long as it's not passing it, we're going to keep calling it a higher high and a higher low. At each high, we call it a higher high. At each low, we call it a higher low. So what it means is that the market at this point here, or at this point here, or at this point there is something that if you box out this area, if you box it out and just keep looking at it, why did the market make a higher low here? And you study the previous line from where it went to the higher low to the higher high, and just study why did the market reject at this area, at this next higher low? What did it make up higher? What did it do? So once you have this market structure ideas in your head and start to analyze it, why it's making the higher highs at this point and why is it making the higher lows, sometimes you might not have a higher high reference because it's making new highs and the market is bypassing all these numbers. So for example, let's say a few years ago, the market NQ was trading at 15,000 as an absolute high. That's the highest it was. So, and then in a few years time, it started trading to 18,000. Did people know that it was going to go to 22,000? No, no one knows. Only the market makers. These people are the ones who are controlling the market, making these moves and adjusting the market as per their own needs. And same thing goes when the market is going in a downtrend. So when it is going in a downtrend, it is making let me just correct it here. It is making a lower low and then a lower high, a lower low and then lower high and then lower low. So at these points, the market is making emerging new lows. Okay, so what do I mean by lows is that it's trying to visit a previous price action. Okay, so when it makes a lower low, it's trying to bypass a previous price action. That's how I understand the markets. So when you look at this point, always look to the left side. Where is it trying to make that lower low? Where is it trying to break out? Of course, most of the times, it would try to break out at a higher low, okay, at the previous higher low. That will be the liquidity for this lower low, the next lower low, okay? That will be the best liquidity that you'll be looking for. So the market continues to go down, hits the higher low there, takes the liquidity, and then starts to jump back upwards. But the market right now, it's in a bearish conditions due to some market conditions and due to the news and so on. So it makes a lower high and then starts to send the market even lower. It doesn't want to go higher, reach higher pricing. So when it makes its lower low, our target is this lower low first, all right? Does the market go and breach this lower low first? Okay, that's a market structure change. So that's a break of structure. Then the market is going in a downtrend. It's going to continue in a downtrend until proven otherwise when making another higher high and a higher low, okay? So once it does that, it breaks the structure. So how does the market break structure? Is that whenever, let me erase these, as long as I explain to you this higher high and higher lows, now I can explain to you how does the market break the structure. Okay, let me erase this one at left as well. So the markets on the left side, I'm going to show you, it is going up, down, up, down, up, down, up here. So it made a higher high and higher lows. So at this low, there is a liquidity. At this low, there's liquidity. At this low, there's liquidity. At this low, there's liquidity. And at this low, there's liquidity as well. But does the market really want to go all that down? No. It will take certain liquidities and tries to reach out to them. It doesn't reach out to all the liquidities. Okay? It's just to certain areas. But what do we do when we are trading? We let ourselves target one liquidity at a time. Target one liquidity, take most of your profits at one liquidity, and then let the remaining contracts or remaining lots, whatever you are trading with. Let's say you traded here 6 contracts, you take up 4 or 5 at this certain liquidity there. Okay, if you're trading the market's breakout structure, when you're trying to get the breakout early or trying to take out the funds, this is the point that as a confluence that you'll be providing yourself that, okay, at this one we have liquidity, we might be taking out. Why? Because this is a higher low and this is a higher high, and then suddenly the market is doing some gyrations here and wants to send us lower. But this one only takes time to understand when the market is tending to break lower. There are some confluences that you guys will need to manage. So when the market is breaking structure, it will tend to go back from the higher high all the way down, breaking this higher low mark. So when it breaks this higher low mark and it starts going downwards, then we can say, okay, there is a market structure break. But we need a confirmation. Does the market actually break out, or does the market just fakes out a breakout of the structure that is making a higher high and higher low and continue to go upwards again? All right. Otherwise, if it doesn't, then our next trade would be around these areas here, around this high. So this is the lower high that it will make, and then it will continue to break further higher lows. So in this structure, it will give you some confluences. It is not 100% strategy, okay? There's nothing called 100% strategy. We are not the ones that are controlling the markets, but we are seeing this happen more often than it doesn't, okay? There are certain times that this information that I'm giving you, the break of market structure, might not work. So you're not getting 100% strategy in any of the strategies that you see online. Some of them have a high percentage of win rates. Some of them are requiring you to be wary that these strategies are not 100%. So when it goes to this lower high, it drives lower, and then it makes a lower high, it makes another lower low down there, another lower high, and then it continues down to break further higher lows at the left side. Okay, so always refer to the markets over here as it's making these structures. And I can guarantee you that these types of gyrations of higher high and higher low, market structure is broken, and market structure movements of a higher high and higher low is always visible in any of the time frames that you look. You look at the 1 month, you will find it. You look at the 1 week, you will find it. You look at the daily charts, you will find it. Every single charts that you are looking at in different time frames, you will find it, no matter what asset you have. Okay, no matter what asset you're trading on, you're gonna find these gyrations. Okay, so this is the market structure, and this is how the market will be moving, and the break of structure, that's how it happens. The break of structure will have multiple confluences that you will have to learn about in the future. There's there is this confluence that is called the liquidity. Number one, you need to understand where liquidity forms and how liquidity sweeps happen. So the liquidity portion will be a quite huge one. The second one is a fair value gap, which is FVG. So this one is from ICT. He defined it, fair value gap and so on. You can also have a look at it. And there's also the order blocks. So once you understand these three types, first off, we need to go in order, and you need to understand that we are looking for liquidity first. Always when you start the charts, you need to find liquidity. I don't need you to care about the fair value gap, the order blocks. If you do not know where the liquidity is, you as a trader will 100% fail at the fair value gap, will 100% fail at an order block. And also, there is one other information, is that market gaps. Okay, market gaps. So these market gaps, the market doesn't like to keep them open, as we understand, right? Most of the traders who are already in the market will know that market gaps will tend to be closed by a body of a candle, not by a wick only. So it tends to be closed by a body. But what if the market did not close it by a body? It just did this and it continued to go in a certain direction. It is possible. It is possible that that wick fulfilled its duty, and the market makers will not want to go back to it and will force the algorithm to change its direction. So the market is controlled by the algorithm, and you can see when it is a very clean pricing, it will provide us a very clean higher high and a higher low, a very clean higher high, higher low, and higher high, higher low, higher high, higher low. And then the market structure will break as the market makers are trying to change the direction of the market to deflate this movement. They want to buy at a very low pricing, okay? They don't want to continue to keep selling. So what they do is that they want to they want to sell at this market point, and they want to buy, let me change the color, they want to buy at this location. So what they do is that they want to take the best positions, of course, the highest and the lowest. So what we will do is that we will try to make the same decisions as the market makers. So we will try our best to identify when the market structure is being broken and when the market structure is being reversed. So there's a reversal movement. It will not continue back all the way here. The reverse movement will continue back upwards. So the more in depth we go into the charts, the more we will see all of this happen. So this is a daily chart that I'm telling you to look at. And then when you go to see the 1 hour charts, you're gonna see it even further, that these markets are already doing the same thing again and again. So it's just that we need to extend the charts further upwards like that and just see it in a zoomed in picture. So over here, for example, I'll take another screenshot. This is a 1 hour charts. So the markets will make a higher high, a higher low, and then a higher high, higher low. And then it starts doing a smaller versions of a lower low and a lower highs, lower low, the lower high, lower lows, and then boom. Where did it break? It broke this structure. It broke this higher, this lower low. It went past it. Okay. This was to be a higher low, but when it went up, it stopped here. It did not move. So this becomes a lower low. And what did the market do? It broke the lower low, and now it's trying to change directions again. Okay, it will do that. Always, it has to break the lower low of the previous one in order to continue the lower movement. But at this point, when it broke this lower low on the left side, it went upwards to make a higher high above this point here, and then a higher low. Okay, and then a higher high, higher low, and then some consolidation. Okay, I don't care about the consolidation too much in terms of defining the market structure. However, the consolidation is a very powerful tool to define liquidity. So you need to be very careful when the market is consolidating like this. You have no idea where the direction would be going. Okay, so as a trader, I want you to avoid trading at these points whenever the market is doing this structure, because then you have a liquidity on both sides and you don't know where the market will go. You're only gambling if you're trading in a ranging movement. You need to wait until one of the liquidities is swept and see whether the market will provide you a reversal or a continuation path for your trade. Okay, I'm not telling you to go and trade it. It is very risky and it is very, very, very unprofessional of you to go and do it. So as a trader, I want you to be very aware of these movements. So I'll teach you another thing as well when the market is making a higher high and higher low. So how do you identify where the market could go when it's making a higher high, a higher low? So let's grab the Fibonacci. This is not 100% strategy, I'm telling you. We grab the Fibonacci. So before I go and tell you the Fibonacci, could you please just look at these values that I have turned on, copy them into your Fibonacci and save it. Save it as a template, okay? I'm doing extend to the right, lines to the right, because I want to have the lines going to the right side. I like to highlight the 0% and the 1%, which is 100%, as a different color from the rest. And I want to highlight the 50% in a gray color so that it doesn't do much of an effect on me. And I like to highlight the 62% and the 79% as well, as you have seen here in the charts. Okay, everything else, turn it off, you don't need it. And here's the lowered ones. I want you to turn on the backgrounds as a new trader. It's going to be very, very, very distracting seeing those rainbow colors. I understand that not everyone will like them, but keep your charts clean. So this is the full thing that I have, and this is what I'm using for the Fibonacci's, okay? So when the higher high and a higher low is formed and you understand that the market structure could break, you draw the Fibonacci and just check how the levels are being oriented. Every single time you go and study the charts, do this updates. So you take it from the lowest, okay? So the market will always go from the point downwards, okay? You take it from down to up, down to up, okay? Always when it's making a higher low, so when it's making a higher high and then a higher low, you need to make a Fibonacci from the bottom of the move to the top, okay? And if it is reversed, you make it from the top of the move to the lowest, okay? If you think the market will go downwards. But since we think the market is going upwards, we take it from the lowest point here on the left side. Where did the market travel? Just think about it. Where did the market travel? It went higher. Okay, so we start from the lowest point at the left side to the highest points on the right side. And that's how we define our Fibonacci's, okay? So we take up the trades and we look it up and we see that the market is actually going down to the 50% mark. So I want you to hold very dearly that 50% mark and put a range, okay? So the 50% mark here, the market tends to be in a very expensive area, okay? It's very, very, very expensive. So ICT likes to call it as a premium market. A premium market where market is very, very, very high in price, and you should wait whether to identify it as a premium market or as a discounted market. So when the market is making higher high and higher lows and it's going to the bullish direction, where you want to trade is not in the premium, not in the red box. So above the 50% is a premium. You don't want to pick your trades there. You want to take your trades around the 50% or below it. So do not take it above the 50%, take it below the 50% when the market is discounted, okay? So over here, the market is at a discount. So I cannot type it like that, okay, sorry. So the market is at a discount at the bottom portion, which is in blue. So I want you to go every single time the market makes a higher high and a higher low, just understand how much was the market discounted and at which level did it discount to. And once it makes that, I want you to go to look at the left side. Why did the market reject at that certain point? And why did the market make a consolidation here. And what did the market do within these consolidation movements, a very short consolidation movement? What did it do? Okay, I'll explain it later because there's a very nice charting here. So what did the market do? Why did it go to the discounted version over here and then start to trade up higher and making this very gigantic move upwards? So in that option, once you start doing this Fibonacci, doing a discount and a premium, understanding when you should enter the trades, you will have another level of knowledge than any other new traders. You'll become on a medium level trader level. Okay, so you'll have a very high knowledge at this point. Once you start identifying, okay, I am being patient right now, I want to understand whether the market gives me a discounted price. When a price is a discounted value at the blue area, and I see the Fibonacci, what is it doing? Does it give me any prices around that Fibonacci levels? The Fibonacci levels are just references to me. I'm not going to use these Fibonacci levels to enter as at an exact number. I just like to see them. How does the price react at those levels? I just want to have them as a marker. That's all I need. Does the market deliver below 50% and give me a discounted price? Good. I'm entering with the market makers. Yes, great job. And when market is going lower, when the market is going lower, am I entering at a premium to drive the prices lower? Okay, that's what I should do. Am I entering from a high? So let's do this. Let's do it. Okay, I just showed you when the market is going upwards what we should do. Now let's check what the market is going downwards. What should we do? Okay, so the market's over here, it stopped and it went lower. So this is our low. Okay, so what did I say? The markets will always go when it's beyond the 50%. Just count that whenever we are going towards the 79 and so on, the market there is at a discount. But this time we will say the discount is at the bottom and the premium at the top. So when we are selling, I'll just take the same understanding and put it down here because this one is a let's make the blue one as a discounted price, okay? And this one is the premium, okay? This is what I want you guys to understand. So when the market is going downwards, okay, when the market is going downwards, I'll take a screenshot to explain it. So the market is going downwards here. It's going downwards. It hits a level and continues back upwards, okay? So we take the Fibonacci, and it's not always the same, guys. It's not always the same. So we might be wrong about this, and it's not us who define the markets, but we always, as a trader or as a human being, we always have that idea and notion that we want to take the best trades, like the market makers. So how do we identify these trades? Is by looking at the charts, whether it's making a higher low, a higher high. Does it provide us a rejection around certain levels, and how do we understand that? We draw Fibonacci all the way down here, from that point to that point, okay? This is the 50% mark in blue, all right? When the market is above here, it is at a premium, okay? When we are bearish, we want to sell at the premium level, okay? And when we are bullish, we want to buy at the discounted price. Okay, why is that? Because people, when we are selling to them at a premium, we want, like, think about it like a real estate. Okay, in real estate, it keeps on expanding in price, inflation, it keeps on inflating in price. You sell it for 4 million, and then if you didn't sell it at 4 million at that time, maybe in the next 2 years, the markets will depreciate and your assets will decrease in value. It becomes 3 million. So you would have lost 1 million in profits. So that's how you need to think about it. When you're selling at a premium, you're selling at a very expensive price. And who is going to buy it? The people at the bottom here. So you're selling it to the people at the bottom. So people at the bottom are offering that price, and that's how you're going to be challenging yourself to do. All right, I want you to draw Fibonacci from the highest point to the lowest, okay? Because the market did the highest point and then went down, okay? Then we look at these levels, Fibonacci levels. The 50% mark has been reached at this point. Let me erase all of this. Okay, keep the charts clean, keep the charts clean. I'll not do this, I'll just need you to understand it because I need you to train your eyes to see this automatically. We reach this 50% level, the price goes up higher. It goes into the premium range. So in the premium range, the price keeps channeling through, getting orders, channeling through, goes up in the gyrations. And then once it's fed up and it wants to go below to their discounts and start to sell to people, it will make these gyration movements, weird consolidations that are happening in the premium range. So you should be a seller in the premium range, okay? You need to sell at this point here. You need to sell at this point here. This point, this point, this point, this point. It depends on your budget, okay? This is all depending on how much money you're willing to sacrifice, okay? But I'm not telling you to trade randomly, okay, at these points. No, there are certain confluences that we will learn in the future. But I would rather you guys to be sellers in these regions, at these highs, not at these lows, when it's going to exit. There is a possibility where you can exit down here, when you can enter the trade down there, but only if the trade is going to give you a very, very, very high confidence that it will be going down, breaking below the 50% level. All right, so that's how we are trading the markets. If it is going lower, we are wanting to sell at the premium, and if it is going higher, we want to buy at a discount price. Same as the market makers. So we want to make the same decisions, and this is how you guys are able to make these decisions thoroughly. Okay, so take this knowledge, take it up with yourself, learn the market structure, and use the Fibonacci tool to understand how does the market react to those levels. Look at the charts, identify it, go to all the time frames, go to all time frames. I don't care which time frame you may choose, just go. The market will do the same exact thing in all the time frames, okay? Train your eyes, train them. Training. No one is perfect. We all have lost our battles during the trading, and I want you all to do the same thing. Do the Fibonacci, understand it, look at it in a live market, do the Fibonacci in the live market at least a few times, do it for 2-3 months, understand all the concepts that we are trying to tell you guys. But if you fail at doing it, then you will be not successful as a trader. You will always struggle, you will always fail at understanding these concepts, and you will say, oh, these concepts don't work, and you don't give them time. That's all. You don't give them time, and you don't understand at which day you are trading and what is the news going on there. Is the market manipulated? And I can 100% tell you that if the market is manipulated, none of these concepts will work. So that's why I need you guys to go and understand at which days is the Fibonacci working with you, and at which days this higher high and higher low is broken or manipulated. There are days everyone knows that market is manipulated. You can see it. But if you're a new trader, you need to train your eyes to understand what manipulation is. All right, guys. So see you in the next trading lesson. I will try to explain to you as much as possible. I still didn't decide on the next lesson subject, but as soon as I find out, I will hurry and give you an update on that one. Yeah. So please make sure to like the video. I really appreciate it, guys. And yeah, leave a comment if you want to see anything in the future, and make sure to subscribe. Thanks, guys. See you.